Let us sit down and look at some numbers that are quietly reshaping the global financial landscape tonight. The bond market is currently experiencing a structural shift that has not been seen since the great financial crisis. The yield on the United States 30-year Treasury bond has officially broken past the 5% threshold. Now, you know me. I do not care for sensationalism, and I completely refuse the industry of financial fear. But when the foundation of global asset pricing moves this significantly, we owe it to our capital to look at the math. I remember when I first started tracking macro data in my early 20s, I used to think the game was about finding the next hot asset. I thought I was an absolute genius for catching a short-term rally, which was really just an illusion before the market taught me about real risk. The truth is much more boring. It is simply about understanding historical patterns and staying completely unemotional when the crowd panics. Let us understand exactly what a treasury bond yield represents without the complex jargon that institutional managers love to use whenever the government needs to fund its massive annual deficit. It issues debt securities to public and institutional investors. A treasury bond is essentially a personal loan to the government, which promises to pay a fixed interest rate over a set period of time. For nearly 15 years, our entire economic ecosystem was built on the absolute certainty of cheap capital. Mortgage rates were low because borrowing was heavily subsidized, and equity prices marched upward because capital had nowhere else to go. But when you can earn a guaranteed 5% return from the safest borrower in the world, the mathematical equation changes. Every asset class in the world, from equities to real estate, must now justify its risk premium against that risk-free rate. The reason bond yields are spiking right now is not because of a sudden market malfunction, but because investors are selling government debt. When investors sell bonds, the price of those bonds falls, which mechanically pushes the yield higher to attract new buyers. This selling pressure is a direct reaction to structural economic indicators that we need to examine calmly together. First, consumer price inflation recently reported a year-over-year increase of 3.8%, which remains incredibly sticky. More importantly, producer price inflation, which measures the wholesale costs businesses pay before passing them to consumers, rose by 6%. When manufacturing and supply chain costs remain elevated, corporations eventually compress their profit margins or raise retail prices. Second, global energy pressures have driven oil prices significantly higher, flowing directly into transportation, shipping, and food production. Third, the domestic fiscal deficit is expanding by roughly $2 trillion annually, requiring an unprecedented volume of new debt issuance. When the supply of government bonds increases dramatically, while foreign central banks reduce their purchasing, yields must rise to attract buyers. Historically, whenever the 30-year yield approached 5% over the past 2 decades, it acted as a temporary ceiling. Investors would step in, purchase the bonds, and yields would glide back down toward lower levels as demand stabilized. The core concern among institutional risk managers today is that 5% is no longer behaving as a temporary ceiling, but rather as a structural floor. If 5% becomes the new baseline for global capital, it creates a slow constriction across 4 primary areas of the economy. First, it impacts the federal budget through an accelerating debt servicing cycle. The government currently spends over $1 trillion annually just on net interest payments for the national debt. Every incremental increase in bond yields adds billions to that interest burden, widening the deficit and requiring further debt issuance. Second, it compresses equity valuations, particularly within high-growth sectors like technology and semiconductors. When future corporate earnings are discounted back to the present day using a higher interest rate, their current mathematical value decreases. Third, the residential real estate market experiences an extended structural freeze. Homeowners who secured long-term mortgages at 3% are financially disincentivized from selling and relocating to a 6% rate. This dynamic restricts housing inventory, keeps nominal prices sticky, and reduces overall capital mobility. Fourth, corporate borrowing costs rise, forcing businesses to delay capital expenditures, moderate hiring, and protect current cash reserves. This does not mean the financial system breaks in a spectacular crash tomorrow morning. It means the economy faces a slow, regulatory grind where the probability of a recession quietly increases with every basis point change. So how do we look at this situation as a generation trying to build durable wealth? When I managed to save my first $100,000, it was not through speculative options trading or chasing momentum. It was through a completely boring process of maximizing my primary income, lowering my overhead, and consistently accumulating productive assets. For an individual saving for a short-term objective, or someone prioritizing capital preservation, earning a clean 5% yield is a reasonable tool. But we must remember that fixed income securities are fundamentally designed to preserve nominal capital, not to maximize long-term wealth. Over a 10 to 20-year horizon, historical data shows that equities have consistently outpaced fixed income because you are compensated for taking risk If you panic during a market contraction and liquidate your equity portfolio to buy long-term bonds, you are hiding from temporary volatility, but you are potentially doing so at the permanent expense of your long-term purchasing power. Furthermore, we must distinguish between short-term treasuries and long-term bonds. Short-term treasury bills maturing in 3 to 6 months behave essentially like cash instruments, providing high liquidity and zero price volatility. Long-term 30-year bonds, however, are highly sensitive to interest rate fluctuations and can experience severe capital losses if yields continue to rise. Look at global fixed income metrics tonight. The United Kingdom long gilt yields have reached levels not seen since 1998. The sovereign bond yields of Japan have climbed to multi-decade highs, confirming that the era of artificial liquidity is drawing to a close. This is a slow structural readjustment where the cost of money is returning to its historical norm after a long period of distortion. The most realistic path forward is not an overnight systemic collapse, but a gradual calibration of asset prices to a higher discount rate. Our responsibility is simply to maintain maximum structural flexibility within our personal balance sheets. We achieve this by avoiding unnecessary consumer leverage, ensuring our monthly cash flow remains strongly positive, and keeping a liquid capital cushion. There is absolutely no shame in observing a market rally from the sidelines if the underlying data does not align with your risk parameters. The only true error is letting societal fear or peer pressure dictate your capital allocation strategy. The optimal time to audit your portfolio and establish clear rules is always when the environment is relatively stable. Once a correction begins, the human brain enters a state of emotional panic, making logical decisions mathematically impossible. Let us use this quiet period to build our knowledge base, refine our target watch lists, and trust the compounding nature of patience. Take proper care of your capital, stay incredibly disciplined with your process. And I will talk to you very soon. Let us think about the psychological transition we have to make when moving from a zero interest rate environment to this new reality. Many investors who entered the market after 2020 have only known a world where asset prices recover almost instantly. They learned that buying the dip was a universal law that always resulted in a quick profit within a few weeks. But history shows us that real structural adjustments can take years to play out, and patience becomes the ultimate competitive advantage. When capital costs 5% at a risk-free rate, speculation loses its fuel, and businesses must prove they can generate real net income. We are moving away from an economy that rewards financial engineering and returning to an economy that rewards fundamental productivity for our portfolios. This means we should look at businesses through the lens of a business owner, not a short-term trader. We must ask whether a company has a clean balance sheet, strong free cash flow, and a product that customers will pay for even during a slowdown. If a company relies on constant debt refinancing to survive, a 5% interest rate environment will slowly erode its margins. I used to look at high growth charts and feel a massive sense of missing out, thinking that everyone else was getting rich faster than me. But after calculating the math behind long-term compounding, I realized that avoiding catastrophic losses is far more important than catching every peak. If you lose 50% of your capital in a speculative asset, you need a 100% return just to break even. When you understand that simple mathematical truth, your entire approach to risk management changes instantly. You stop looking for multi-baggers overnight, and you start looking for consistent, resilient compounders that let you sleep through the night. Let us look at the concept of opportunity cost through this exact lens. When the risk-free rate was zero, holding cash felt like a slow penalty because inflation was quietly eating away your purchasing power. Today, having a high-yield savings account or a short-term treasury bill paying 5% gives you an option value. Option value means having the liquid capital ready to deploy when a high-quality asset experiences a temporary liquidation event. It means you do not have to force a trade today because your cash is actively working for you while you wait for the right valuation. This approach requires an immense amount of discipline because the internet will constantly tell you that you are being too conservative. But the numbers do not care about internet trends, and the long-term data supports the investor who protects their downside. Let us analyze what happens inside large institutional funds when these yield thresholds are crossed. Pension funds and insurance companies operate under strict regulatory mandates regarding their future payout liabilities when they can secure a guaranteed 5% return for 30 years. They naturally shift billions of dollars out of equities and into fixed income. This institutional rebalancing creates a quiet but persistent headwind for the equity market, reducing the overall multiple expansion we saw in previous years. This is why the market breadth has become so incredibly narrow. With only a few megacap companies driving the majority of index returns, the broader market is already adjusting to higher capital costs, while the top index constituents hide the underlying reality. As individual investors, we do not need to fight these institutional flows. We simply need to position ourselves to benefit from their necessity. We can do this by focusing on companies that possess pricing power, meaning they can raise their prices alongside inflation without losing their customer base. We can also look for companies with a high return on invested capital, as they can fund their own growth without relying on expensive expensive debt markets. These are the boring truths that do not make for exciting social media headlines, but they are the exact truths that build multi-generational wealth. I want us to take a close look at how we manage our personal liabilities during this transition. If you are carrying variable rate debt, such as credit card balances or personal loans, that interest rate is adjusting upward rapidly right now, paying off a high interest liability provides a guaranteed risk-free return equivalent to that debt interest rate. Before we even think about maximizing our investment returns, we must ensure our personal foundation is completely free of high interest leaks. I used to think that carrying a little bit of debt was fine, as long as my investments were growing faster, but that was a dangerous assumption built on a bull market illusion. And a true risk framework eliminates that vulnerability entirely. Let us talk about the upcoming macro calendar for June, as it contains several key milestones that will dictate the summer trend. The Organization of Petroleum Exporting Countries will meet early next month to determine global production quotas, which will directly impact energy inflation. Simultaneously, the central bank will deliver its updated interest rate dot plot, detailing exactly how many policymakers expect rates to stay elevated. If the data forces the central bank to maintain this 5% baseline longer than the market expects, we will see continued asset repricing. We should look at these events not as a reason to trade actively, but as a laboratory to observe how different asset classes react to changing capital costs. The more you observe these cycles without emotional attachment, the more you realize that the market is simply a massive voting machine in the short term, but over the long term, it functions strictly as a weighing machine. Measuring real cash flows and real economic utility, our goal is to ensure our capital is placed entirely on the side of the weighing machine, anchored by logic and mathematical necessity. Let us check our current asset allocation to ensure it matches our true holding timeline. If you have capital that you will need for a major life event over the next 24 months, that capital has no business being exposed to equity volatility. With short-term yields at 5%, that capital can sit safely in risk-free instruments, preserving your peace of mind and your upcoming plans. Only capital with a timeline stretching beyond 5 to 10 years should be navigating the fluctuations of the broader equity index by segmenting your wealth according to time horizons. You remove the immediate pressure of daily market movements. You can watch a red chart without feeling a racing heartbeat, because you know your immediate needs are fully collateralized by short-term certainty. This is the ultimate secret to remaining calm when the surrounding media environment enters a state of perpetual panic. I want to encourage you to take an hour this weekend to write down your personal investment policy statement, define your exact target asset allocation, specify your maximum leverage limits, and outline your rules for taking profits during expansionary phases. Having a written document prevents you from making impulsive decisions in the middle of a market correction. It acts as your personal anchor when the financial waves become choppy and the noise becomes deafening. I will be diving much deeper into these exact balance sheet metrics during our live online session. This coming weekend at 10xreturns.org, we will look at actual company case studies, calculate real cost of capital adjustments, and build a framework designed for structural endurance. There is no cost to attend, and there will be no high-pressure sales tactics. Just a quiet, data-driven conversation between peers. Bring your notebook, leave the market anxiety behind, and let us focus entirely on the numbers that matter. Thank you for spending this quiet time with me tonight and for trusting the slow, disciplined path to financial independence. Take excellent care of your capital, protect your compounding timeline, and I will speak with you very soon.